Hello guys, we are going to discussing today different types of life insurance which are listed here, like cash value, whole life, modified whole life, joint whole life insurance, universal life insurance, variable life insurance, endowment, difference between cash value and face value. A cash value life insurance, sometimes referred to as permanent life insurance, provides the life insurance coverage throughout the insured's lifetime and provide a saving element known as cash value. There is another term, a cash surrender value is the amount that a policy owner is entitled to receive upon surrendering the policy before adjusting for factors such as policy loans and applicable charges. Whole life insurance, it is a form of cash value life insurance that provides the lifetime insurance coverage at a level premium rate that doesn't increase as the insured ages. Whole life insurance policy include a table that illustrates how the policy's cash value will grow over time. If the policy doesn't remain in force until the insured death, the insurer agrees to refund the cash value to the policy owner, less any surrender charges and outstanding policy loan. Whole life policy can be classified on the basis of length of the policy's premium payment period. Most whole life policy are classified as either continuous premium policy or limited payment policy. First one is continuous premium policy, sometimes called a state life insurance policy or an ordinary life insurance policy. A whole life policy under which premium are payable until the death of the insured. Because premium are payable over the life of the policy, the amount of each premium payment required for a continuous premium whole life insurance is lower than the premium amount required under any other premium payment schedule for a whole life policy. Another is a limited payment policy, a whole life policy for which premium are payable only until some stated period expire or until the insured death, whichever occur first. Premium payable for a specified number of year or premium payable until the insured reaches a specified age. There is another term, paid up policy, in which no further premium payment required but continue to provide coverage. Next is single premium whole life policy, a type of limited payment whole life policy that require only one premium payment. Next is modified whole life insurance. As we have seen, traditional whole life policy provide a constant face amount of coverage in exchange for a series of level premium or a single premium. However, under some whole life policy, either the amount of the required premium payment changes at some point in the life of the policy, or the face amount of the coverage changes during the life of the policy. Now, joint whole life insurance is also a type of insurance that has the same feature and benefit as the individual whole life insurance, except that it insures two lives under the same policy. Joint whole life insurance is often referred to as first to die life insurance because upon the death of one of these insured, the policy death benefit is paid to the surviving insured and the policy coverage ends. To allow the surviving insured to obtain coverage, joint whole life insurance usually provides a specific period, such as 60 or 90 days following the first insured death, within which to purchase an individual whole life policy of the same face amount without evidence of the insurability. Some joint whole life may provide the surviving insured with temporary term insured during the specified period. Universal life insurance is a form of cash value life insurance characterized by its flexible premium, its flexible face amount and death benefit amount, and its unbundling of the pricing factors. There are some separation of policy element like mortality charge. You can read all after pausing the video. What is mortality charge? Is the amount needed to cover the mortality risk the insurer has assumed by issuing the policy. And another factor is interest. A universal life policy guarantees that the insurer will pay at least a stated minimum interest rate on the cash value each year. It also provides that the insurer will pay higher interest rate if economic and competitive conditions warrant. Third one is expenses. Each universal life insurance policy lists the expense charges that the insurer will impose to cover the cost incurred to administer the policy. The following expense charge may apply: flat charge, some percentage of annual premium, management fee, surrender charge, service charge. Operation of a life insurance policy. When an insurance receive a premium payment, it first deduct the amount of any applicable expense charges and then credit the remainder of the premium to the policy's case value. Each month, the insurer deducts the periodical monthly mortality charge from the cash value and credits the remaining of the cash value with interest. The more a cash policy owner pays in the premium above the amount needed to pay the policy's cost, the greater the cash value. If the cash value is not sufficient to pay periodic charge, the insurer gives the policy owner a stated amount of time, at least 60 days, in which to pay a premium to cover those charges. If the policy owner doesn't make the premium payment, the policy will be lapse. Universal life insurance has flexible feature, like owner of a universal life insurance can determine within certain limit how much to pay for certain premium for each renewal premium. The policy owner also has the great flexibility to decide when to pay renewal premium. There is also face amount and amount of death benefit. At the time of purchase, the policy owner specify the policy face amount and they decide whether the amount of death benefit payable will remain equal or will vary with the changes in the policy's cash value. There are flexible premium universal life insurance policy or fixed premium universal life insurance policy. Also, there is periodic period report that insurer generate, which contain information like death benefit payable, mortality charge deducted, policy loan premium paid during the reporting period, policy's cash value to the it provide to insured annually, also semi-annually, quarterly. There is variable life insurance. It is a form of cash value life insurance in which premium are fixed but the face amount and other value may vary, reflecting the performance of the investment sub-account selected by the policy owner. There can be many number of sub-accounts, like sub-account, separate account, general account. So insured can deposit their premium into sub-account, separate account, general account also. There are some points regarding variable life insurance. Like most variable life policy permit the policy owner to select from several sub-accounts and to change the selection at least annually. Okay, and the insurer follow a different investment strategy for each sub-account. Third is the amount of policy death benefit and cash value depend on how well the separate account perform. Variable universal life insurance. It is a flexible premium variable life insurance, a form of cash value life insurance that combines the premium and death benefit flexibility of universal life policy with the investment flexibility and risk of variable life insurance. Like a universal life policy, a variable universal policy allows the policy owner to choose the premium amount and face amount. Like a variable life policy, the cash value of a variable universal life policy is placed in the separate account. A variable universal life policy doesn't guarantee investment earning for or cash value. A variable universal life product is considered as security in the US and thus must comply with federal security laws. There is endowment insurer. Endowment insurer provides a specified benefit amount whether the insured lives to the end of the term of the coverage or die during that term. Each endowment policy specifies maturity date, which is the date on which the insurer will pay the policy's face amount to the policy owner if the insured is still living. The maturity date is reached either at the end of the stated term when the insured reaches a specified age. In this insurance policy, cash value build rapidly. There is difference between face value and cash value. Face value Once again, face value is the amount you purchase the policy for and is used for all life insurance policy, even term, regardless of the performance of the policy investment. The policy face the face value of the policy will not change. For example, if you purchase a whole life policy for $200,000, your named beneficiary will receive face value after you pass away, even if the investment of the policy have gone bust. You will receive face amount, but cash value, it depend on the performance of the investment. So if your investment will good, you will receive more cash value. Okay guys, that's all from our side. Thank you for listening us. Bye bye.